Welcome to the Tidecrest Triple 3's for May 2026. Each month we spotlight 3 numbers impacting the capital markets, 3 news stories driving investor sentiment, all in 3 minutes. Let's dive in. 4.65%, 10-year Treasury yield. The yield on the 10-year U.S. Treasury note has surged to approximately 4.65%, its highest level in over 16 months, as energy-driven inflation fuels expectations that the Federal Reserve may raise rates rather than cut them. Why it matters. The 10-year Treasury yield is the benchmark rate that prices everything from mortgages to corporate bonds. When it rises sharply, borrowing costs climb across the economy. The current move reflects a significant shift in investor expectations. Earlier hopes for rate cuts in 2026 have been replaced by growing concerns that the Fed's next move could be a rate hike. That repricing touches virtually every asset class. $39 trillion, U.S. national debt. The U.S. national debt has surpassed $39 trillion, with annual interest payments now projected to exceed $1 trillion, more than the entire defense budget, as rising yields make refinancing existing debt increasingly costly. Why it matters. Federal debt at this scale, combined with high interest rates, creates a compounding problem. More debt requires more borrowing, which pushes yields higher, which increases the cost of debt further. This dynamic contributed to Moody's stripping the U.S. of its last AAA credit rating last year. Fiscal sustainability is no longer a theoretical concern, it's a market-moving variable. 50%, market-implied odds of a December rate hike. Market-implied probability of a Federal Reserve rate hike by year-end 2026 has climbed to approximately 50%, a dramatic reversal from earlier in the year when markets widely expected multiple rate cuts before December. Why it matters. Interest rate expectations are one of the most powerful forces in financial markets. A coin flip probability of a hike signals deep uncertainty about a Fed's next move, something markets have not priced in for years. This level of ambiguity tends to increase volatility, widen credit spreads, and compress valuations on growth-oriented assets. Investors are navigating an environment where the direction of policy is unclear for the first time in a while. Retail sector whiplash. Retail earnings are sending a split signal. Strong numbers alone aren't enough. Target posted its largest sales jump in years, but shares slid sharply after executives struck a cautious macro tone, erasing early gains and spooking investors. However, Home Depot and Lowe's told a different story, with both retailers beating Wall Street sales and profit expectations and finishing the day higher. Why it matters. The divergence signals a consumer that's increasingly selective. Shoppers are still investing in their homes, but pulling back on discretionary spending. And when even a strong sales print can't lift a stock, it tells you the market is more focused on what's coming next than what just happened. Global bond market sell-off and rising Treasury yields. Bond markets around the world have experienced one of their sharpest sell-offs in recent memory, with yields on U.S. Treasuries, European sovereign debt, and other government bonds climbing to multi-year highs as the conflict in the Middle East and resulting energy shock force a global repricing of inflation and interest rate expectations. Why it matters. A synchronized global bond sell-off tightens financial conditions everywhere at once. Higher yields raise borrowing costs for governments, corporations, and consumers across every major category. When the bond market reprices at this scale, it ripples through equities, real estate, and credit markets simultaneously. Stagflation risk returns to the conversation. With oil prices roughly 50% above pre-war levels and the U.S. economy still showing underlying resilience, investors and economists are grappling with rising inflation, while growth concerns mount, prompting conversations around stagflation. Why it matters. Stagflation is widely considered the most difficult macroeconomic environment for central banks and investors alike. Traditional portfolio construction, where bonds offset equity risk to some degree, breaks down when inflation is a problem because rising prices, rising rates, and slower growth hurt both asset classes simultaneously. If energy prices remain elevated and pass through into core inflation over the coming months, the stagflation story will become front-page news. For now, it's worth keeping an eye on how things develop. That's the Tidecrest Triple 3's for May 2026. 3 numbers, 3 stories, 3 minutes. We'll be back next month to track what matters most. Thanks for watching.